April 26, 1979. The United States Treasury failed to pay its debts. Not because the money wasn't there, not because of political gridlock, but because of a clerical error, a paperwork mistake that shook the financial world. Investors who trusted America's promise lost money. Bond markets panicked. Yet today, almost no one remembers it happened. This is the story of the day America defaulted on its debt, and why it matters more now than ever before. Because the systems that failed then are still in place today, and the debt ceiling fights we see in the news, they're playing with the same fire that burned us in 1979. To understand how America defaulted, we need to go back to the late 1970s. The economy was struggling. Inflation was crushing American families. Interest rates were climbing toward double digits, and Congress was locked in a bitter battle over the debt ceiling. Sound familiar? History doesn't repeat, but it rhymes. The debt ceiling is essentially America's credit card limit. Congress has to vote to raise it, or the government can't borrow more money. In 1979, that fight went down to the wire. The ceiling was raised at the last possible moment on April 6th. Crisis averted, or so everyone thought. But here's what nobody anticipated. The Treasury Department was overwhelmed. The last-minute debt ceiling increase created a flood of paperwork. Thousands of checks needed to be processed. Computer systems were outdated. Word processing equipment had broken down. Treasury employees were literally typing individual checks on typewriters, and they couldn't keep up. By April 26th, the impossible happened. Treasury bonds matured. Payments were due, and the United States Treasury failed to pay. Let's break down what a Treasury bond actually is. When you buy a Treasury bond, you're lending money to the U.S. government. The government promises to pay you back with interest on a specific date. This promise is considered the safest investment in the world. The full faith and credit of the United States backs every dollar. That phrase means something. It means the U.S. always pays. Always. No matter what. That's the deal. Until it didn't. On that April day, roughly $122 million in Treasury securities went unpaid. That's about $500 million in today's dollars. Thousands of investors expecting their payments were told to wait. Some were retirees, depending on that income. Others were foreign governments watching America's credibility crumble. The Treasury scrambled. They eventually paid everyone back. But they paid late. And in the bond market, late means default. It wasn't a matter of opinion. The contracts were clear. America had broken its most sacred financial promise. And it happened because of a word processor and some broken typewriters. The most powerful nation on earth, brought down by office equipment. But the consequences were anything but trivial. News of the default spread quickly through financial circles. Bond traders couldn't believe what they were hearing. The United States Treasury doesn't default. It's impossible, except it just had. At first, Treasury officials tried to downplay the situation. They called it a delay, not a default. They blamed the debt ceiling fight for creating the backlog. They promised it would never happen again. But the damage was done, because markets care about one thing above all: trust. And trust, once broken, is expensive to repair. Within weeks, something remarkable happened. Interest rates on Treasury bonds began to rise. Not dramatically, but measurably. Investors were demanding a higher return to compensate for the new risk. The risk that America might not pay on time. A team of economists would later quantify this effect. Their findings were published years later and largely ignored. But the numbers told a clear story. The 1979 default permanently raised borrowing costs for the U.S. government by about 0.6%. It doesn't sound like much until you multiply it by trillions of dollars in debt. That paperwork error has cost American taxpayers billions over the decades. Billions of dollars in extra interest payments. Money that could have built schools, roads, hospitals, all because some typewriters broke down. But there's another consequence that matters even more today. The 1979 default established a precedent. It proved that American default was possible, not theoretical, not hypothetical, actual. Before 1979, the idea was unthinkable. After 1979, it was merely unlikely. And that distinction matters in financial markets. Because once something happens once, it can happen again. The Treasury Department did upgrade its systems. They modernized their payment processing. They implemented safeguards to prevent another clerical default. But they couldn't fix the underlying problem, the debt ceiling itself, that political weapon that nearly destroyed American credit. And here's the terrifying part. The debt ceiling fights have only gotten worse. 2011, 2013, 2023. Each time, we've come closer to the edge. Each time, the political brinkmanship gets more extreme. And each time, financial markets hold their breath. Because they remember 1979. Even if the rest of us have forgotten, the markets know that default is not impossible. It's just one paperwork error away. So what would happen if America defaulted again? This time, not by accident, but by political choice. The consequences would be catastrophic. Treasury bonds are the foundation of the global financial system. They're used as collateral for trillions in transactions every day. Banks hold them. Pension funds hold them. Foreign governments hold them. They're considered risk-free in every financial model. If that assumption breaks, everything breaks. Interest rates would spike, not just on government bonds, on mortgages, car loans, credit cards, everything. The stock market would crash. Retirement accounts would lose trillions in value overnight. Banks would fail as their treasury holdings became worthless. The dollar would plummet as global confidence evaporated. America's role as the world's reserve currency would end. And that privilege saves Americans trillions every year. Economists call this the exorbitant privilege. Default would mean losing it forever. The 2011 debt ceiling crisis gave us a preview. We came within days of default. Standard & Poor's downgraded America's credit rating for the first time ever. The stock market dropped 17% in a matter of weeks. And we didn't even default. We just came close. The Government Accountability Office later estimated the cost. That one crisis raised borrowing costs by $1.3 billion. Just from uncertainty. Just from the threat. Imagine what an actual default would cost. But the economic damage isn't even the worst part. Default would shatter America's credibility. For 250 years, America has kept its promises. Through wars, depressions, and political upheaval, the United States pays its debts. That's who we are. Or at least, that's who we were. Because every debt ceiling fight chips away at that reputation. Foreign governments are watching. They're taking notes. China, Russia, Europe, they see America's dysfunction. And they're building alternatives to dollar-based finance. Not because they want to, because they have to. They can't rely on a country that plays chicken with its own credit. The 1979 default was an accident. The next one would be a choice. So why doesn't anyone remember 1979? Because it was embarrassing, inconvenient, easy to forget. The Treasury paid everyone back within weeks. They apologized. They upgraded their systems. And everyone pretended it never happened. Because admitting America defaulted felt un-American. But the bond markets never forgot. They priced in a risk. They demanded higher rates. And we've been paying for it ever since. The question isn't whether we remember. It's whether we'll learn. So here's what I want to know. If a paperwork error cost us billions, what will political brinkmanship cost us next time?